Okay, so we have a whole bunch of assets, of risky assets we can invest in. Okay. The best we can do is to combine them in order to create portfolios that provide us, that give us the highest possible returns for any accessible, for any level of risk. Okay. Or the portfolio that give us the portfolios that give us always the smallest amount of risk for any target return. Okay. So whatever is on the right hand side of the curve here is feasible, is accessible. So B, we can invest in B only. You can invest in C only. You can invest in any combination you want of B and C, okay? But this combination here will never give you access to a combination risk return on the left-hand side of the portfolio frontier. Whatever is on the left-hand side of the portfolio frontier is too good to be true. It's impossible, okay? So the best points are zero risk and whatever you want, okay? That does not exist. So the only point, zero risk, that exists gives you a return of 8%. It's the risk-free rate, the risk-free asset. So the best you should do here, when you have, once you have constructed the portfolio frontier, is to take the portfolio on the frontier that has the highest Sharpe ratio. In this portfolio, we call it the market portfolio. Why do we call it the market portfolio? Since everyone combines the portfolio with the largest Sharpe ratio with the risk-free rate. Well, every investor owns the same portfolio of risky assets. All the investors will be somewhere on the blue line, and this blue line is called the capital market line. Okay, so we call it the capital market line. So the line that starts at the risk-free asset and goes through the market portfolio is called the capital market line. There is only one risky portfolio on this line. It's the market portfolio. Okay. V here is the minimum variance portfolio. So it's of all the risky portfolios, it's the portfolio with the lowest standard deviation. But this is not the one you choose. You should choose the portfolio that gives you the largest Sharpe ratio, which is the market portfolio. Some investors will have a fraction of their wealth invested in M and the other fraction invested in the risk-free asset. So these guys will be saving at the risk-free asset. And the less risk-averse investors will borrow at the risk-free rate to invest even more than what they own in the market portfolio. So, I mean, the risk-free rate in equilibrium will be the rate that equilibrates people who are saving and people who are borrowing, so that whatever is borrowed is saved by someone else. Okay, so this is what will give us the exact risk-free rate. Okay, and once you have the risk-free rate, you take the portfolio frontier and you draw the line that is tangent, okay, with the portfolio frontier, and the tangent C point is your market portfolio. And some investors will be on the right-hand side of the market portfolio, other investors will be on the left-hand side of the market portfolio. But all investors will own the same risky portfolio, which is the market portfolio. So to call the difference E of the expected return of the market portfolio and the risk-free rate, the market risk premium. Okay, so the market risk premium is the weighted. Okay, so define the difference between the expected return of the market portfolio and the risk-free rate, the market risk premium. So the contribution of each asset to the market risk premium is the weight of the asset in the market portfolio times the difference between the expected return of these assets and the risk-free rate. Okay. Now, the contribution of each asset to the variance of the market portfolio is given by this. It's the weight of the asset in the market portfolio times the covariance between the return of these assets and the return of the market portfolio. This is a proof that is beyond the goal of this class, but it's not a difficult proof to make. In equilibrium, the return contribution to return, the ratio contribution to return divided by contribution to risk of each asset should be equal. Okay, so the return divided by risk should be equal for each asset. Otherwise, I mean, if one asset in the market has a higher contribution to return than its contribution to risk, everyone will buy it. The price will go up to the point where the expected return will fall to its equilibrium value. So the weights cancel out. So this gives us the risk premium of each asset divided by the covariance between the return of this asset and the market portfolio should be equal for all assets in the market. Since this is true for all assets, it's also true for the market with the market portfolio. So this gives us the following equation that we can arrange as follows, and this is the CAPM equation. Okay, so the CAPM equation has there are assumptions behind the derivation of this equation. So everyone has the same investing horizons. Everyone has the same beliefs about the market. Everyone. Like people are all rational. So this gives us the CAPM equation. So in the CAPM equation, the expected return of an asset is given by the risk-free rate plus its beta times the market risk premium. So the term beta here, okay, measures the systematic risk of asset I. So beta is the covariance. So beta is here the covariance. So we have here beta I is the covariance of the return of I and the return of the market divided by the variance of the returns of the market. And since this is true with the market portfolio as well, beta of the market portfolio is equal to 1. If we have a portfolio containing NP assets, it's easy to show that the beta of the portfolio is equal to the weighted average of all the assets, the weighted average of the beta of all the assets in the portfolio. So this gives us the security market line. So the security market line gives us the relationship between the expected return of an asset and its beta. In equilibrium, all assets should be on the security market line. So there's only one asset on the capital market line, the market portfolio, but all assets should be on the security market line. So the security market line gives us the relationship between beta here and expected return. When we were dealing with the capital market line, so the value of the horizontal axis was standard deviation. So here we have, so B is an asset with a beta greater than 1. Okay. M is the market portfolio, the beta of M is equal to 1. A is an asset with a beta smaller than 1, and C is an asset with a beta smaller than 0. If your beta is greater than 0, your expected return is greater than the risk-free rate. If your beta is smaller than 0, your expected return is smaller than the risk-free rate. If the expected return of an asset is such that the expected return is inconsistent with the security market line, the difference between the actual expected return and the equilibrium expected return is called the alpha. Okay, so when you say newsletters that say looking for alpha, so you look for assets that are undervalued, that provide a larger expected return than what they should provide given their systematic risk. So if an asset A is such that its expected return is greater than the CAPM equation, the difference is called alpha. Okay, since the expected return is the expected price minus today's price divided by today's price. So assuming that expected return in period 1 remains constant, so the actual expected return is larger than the equilibrium value, so the expected return should fall. So how will it fall? Okay, so if you look at this equation here, so if the expected return is too good to be true, if the expected return is larger than the equilibrium return, every investor will want to buy this asset. So this will push today's price of asset A up, okay, up to the point where the expected return will fall to its equilibrium value, or up to the point where alpha is equal to 0. In other words, if the alpha of an asset is larger than 0, then the asset is undervalued. So its price is below what it should be. If it's the opposite, if the price of an asset is below 0, what happens? Okay, if the price of an asset is below 0, that means its expected return is smaller than what it should be. So people will sell the asset. Selling the asset will reduce its price. Reducing the price will increase the return up to the point where alpha is equal to 0. Okay, so if alpha B is smaller than 0, the asset is overvalued. People will sell it. The price will fall until the expected return is consistent with the security market line. So if the expected return of an asset is given by the CAPM equation, risk-free rate plus beta times market risk premium, then the realized return will be the CAPM equation with realized value plus a difference, like an error term. Okay, so the error term here will capture the difference between what was expected and what was realized. So if the model is correct, the random variable should have a mean of 0 and a positive variance, which means that if we compute the variance of the return of the asset, we have two components. Okay, systematic variance and idiosyncratic variance. So the first component is market risk, and the second component is specific risk.